So to start with, a brief background on angel tax. What is its objective? What are its key components? Then we will straight away dive into the new rules that have come out recently. These are the draft valuation rules pertaining to section 5627B on angel tax. And there are some carve-outs also, some exemptions from angel tax provisions in the form of some notified entities and specified nations. Two very interesting concepts have come up for the first time in angel tax provisions this time. So one is the price matching concept, and the other is the safe harbor concept that has been introduced. We will have a look at these concepts as we move along, and we will conclude the session with an analysis of the impact of these changes on investment and what could be the possible planning and risk mitigating strategies that investors and investees could adopt, considering that angel taxation scope has now been extended. So let's just move forward to the content straight away. So just a brief on angel taxation. Way back, the term angel tax was coined when, in this theatrical show, Broadway theater, affluent individuals provided money for theatrical productions, and they were, colloquially referred to as angels. And since then, in the tax realm as well, this term has come to be coined in the form of angel investing. And now angel tax, which is in a way a contradiction itself, because we are talking about angels on one hand, and at the same time we're talking about taxation. So whatever money which the angel investors are providing by way of capital, we are dealing with it rather harshly. And we have section 5627B, which taxes that capital contribution. And of course, the reason why we are here in this webinar is because overall there is an environment of fear around angel taxation. So before these rules, angel taxation was confined to contributions by residents. Now, after the recent amendment by Finance Act 2023, scope of angel tax has been extended to contributions by non-residents as well. Before you are just some of the familiar and shocking headlines that we saw in recent past in the last 3-4 years as a wave of angel tax swept across India. And this has been a much discussed topic at national and international forums as to why Indian government is enforcing such provisions. Because on one hand, there is a lot of excitement around new capital infusion in India, the India growth story, and India shining. And on the other hand, we are having such a unique provision which taxes capital contributions. And it is a provision which is very unique to India. At least I have not seen this kind of provision in any other country. So that is also a question mark for all of us, for policymakers as well, that why at all do we need a provision like this, which deems capital contributions to be income. So we will discuss more on this also, the rationale and what is whether this is fair or this is unfair as we move along. So before we just get into the nitty-gritties, an overview of the old provision as it existed before the Finance Act 2023. So section 5627B stated that whenever you issue shares to a resident above the fair market value, the difference between the issue price and the fair market value, the excess, will be deemed to be income, and it will be taxed as income from other sources. Right. So just to give a simple example, if your share price is, the issue price is 1,000 and the fair market value of the share is 950. So the excess of 50 rupees will be deemed as income under section 5627B. So this is a deeming provision put in by the legislature, and it has to be enforced. One can question the rationale, but the fact is that this stands on the statute book. Now, after Finance Act 2023, the scope of this provision was extended. So earlier, only investments by residents were covered. Now, even investments by non-residents will be met with a similar treatment. So any contribution by a non-resident in excess of the fair market value that will be deemed to be income and taxed as income in the hands of the investee. So the investor will not have to pay tax on the excess amount, but the startup or the investee will have to pay tax because the excess amount that the investee is getting will be deemed to be income of the investee. Now, again, before we go further into the concept and the changes that have come out in the rules, let's just look at the objective of this provision 5627B when it was introduced in 2012 for the first time with a narrower scope. And also we look at the objective now when the Finance Act 2023 is enlarging the scope of this provision. So originally when it came, it said that this provision is being inserted to prevent generation and circulation of unaccounted money. This was the motto initially when it had come about. And now when the Finance Act 2023 has extended the scope, it has reiterated the original objective, but without giving much rationale as to why it deserves to be extended. They have just said that because earlier it was only covering residents, non-residents were left out. So now we are also taking non-resident investors within its fold. How this provision has worked over the years is that it has become a tax in itself, a levy in itself on contributions to capital. The way the tax department has enforced this provision, the whole concept of unaccounted money or black money, that has somehow been thrown out of the window. Some sanity checks are undertaken by the tax department, like issuing notices to the investors under 133, examining their credit worthiness. But despite the fact that tax department gets satisfactory answers on the source of the funds, even then section 5627B addition has been upheld at the lower levels in many cases. So the manner in which this provision is now being applied, it is being applied without any regard to its original intention, which was to prevent circulation of black money. So this is something which is a very serious question and the most daunting aspect of these provisions, especially now that they have been extended to non-residents also. As we now move forward, let's just have a quick glance at what are the changes that have come about in the angel tax provisions before the amendment and now after the amendment supplemented with rules. So I may just point out that the rules 11 UA notification that has come out as of now is a draft notification, and it was let out for public comments until 5th June. By now the comments would have been received. So the government is obviously looking into the comments and will probably introduce final rules taking into account the comments received. So we, for purpose of this webinar, will look at the draft rules, what are the new methods that they have proposed and what changes that are being brought about. So these are not the final rules. So we've seen that until now, only resident investors were covered, but now even non-residents are covered under 5627B. Earlier, resident investors, when investment was coming from them, only two methods were available, DCF and NAV. The investee company could use either of the two methods, and this was at the option of the investee company. And now 5 more methods have been prescribed. So these methods are internationally accepted methods. And the reason why they have been introduced is that if you are extending 5627B now to non-residents also, so you need to enlarge the scope of methods also, because for international investments, the FEMA regulations stated that any of the internationally accepted methods could be used, whereas the provision 5627B was restricting only to DCF or net asset value method. So now with the introduction of the 5 additional methods, they are trying to align the valuation methodologies under the Tax Act with the FEMA regulations. Along with the enlargement in scope to cover non-residents, some exclusions have also come about. So earlier, when it was applicable only to resident investors, there was one major exclusion, which was a DPIIT registered startup, which would meet certain specified conditions. It would be exempt from angel tax provision, and so were the venture capital funds. Now the government has also come up with a separate notification wherein the government has stated that notified entities investing from specified nations, they will be free from the rigors of angel tax provisions. We will have a look at all of these as we move along. And most interestingly, the draft rules on valuation, they provide for a new method, which is the price matching method. This was not available earlier, but now price matching method is available for both resident, non-resident investors, and safe harbor provisions on valuation have also been introduced. Again, these safe harbor provisions are also available for both resident and non-resident investors. One very interesting change which has come out now under the draft valuation rules pertains to the validity of a valuation report. So until these valuation rules, the norm was that whenever you are going for a fundraising, you need to have a valuation report. The question was that for how long can that valuation report be validly accepted under angel tax provision. So at that time, the general norm was that, a valuation report is valid for 3 to 6 months. The longer the time period, the more possibility it is that there will be a question mark on the acceptance of the valuation report by the tax department. The law stated that the valuation report has to be drawn up at the time of the issue of shares. So it has to be contemporaneous. But how contemporaneous it has to be? Should it be as on the same date when the shares are issued? Could it be near around that time? Because one does not expect company's valuation to be changing day by day. One would expect it to be stable over a reasonable period of time. So now this time finally, the valuation rules specify a 90-day period for which at the option of the assessee, the same valuation report can be used. So for anybody who wants to play, any investor or investee wants to play very safe with the with valuation under Income Tax Act, he has a time period available with him that if my valuation report is dated beyond 90 days, then I can think of having a fresh valuation report drawn up, or at least having a new certification, a fresh certification done by a CA, though my projections by and large may still be the same, or the crux of the valuation report may not change. So these are the main difference. These two tables sum up the main difference between the way angel tax provision existed before the change and now after the change. Now let's just look at each of these changes closely. So I spoke on the additional methods which are available now. So these methods are before you, these are not new methods. They have been used internationally and they are definitely complex methods to be applied by a merchant banker. So a merchant banker has to apply the DSAVE method, and these additional methods which are available in case of non-residents, there also only a merchant banker certification will suffice. A qualified chartered accountant cannot be issuing a valuation report based on any of these additional methods. I wouldn't, since these pertain to the realm of valuation per se, I wouldn't be going deep into any of these methods, but we will be looking at the change in valuation reports more from a tax perspective. So along with these methods, as I mentioned, the government has extended it has introduced some carve-outs from angel tax provisions. So when initially the government announced that the scope of angel tax provisions was extended to non-residents, there was a lot of hue and cry. And in response to the reaction, the government notified certain entities. Again, these notified entities have to be operating from specified territories to be able to get exemption from angel tax. So if we look at what these notified entities are, so government or government-related investors, and second category is banks or regulated entities. For the first two categories, regardless of the territory from where you're operating, if you are investing in an Indian company or an undertaking, then angel tax provisions will not apply. But for the third category, which is entities registered with SEBI as category 1 FPI, endowment funds, pension funds, broad-based pooled investment vehicle, all these categories, you have to be located in a specified territory. Only then. So there are 21 specified territories. If any of these entities which are specified is operating out of these specified territories, only then you will get the exemption from angel tax. These are the 21 countries that have been excluded from the scope of angel tax provisions. And it has been in the news that the three major investment jurisdictions for India, Singapore, Mauritius, and Netherlands, have been kept out of the purview of these nations, including UAE as well. And there have been question marks raised on why government kept these jurisdictions outside the exclusion. An answer to that is that perhaps the government wants that more and more money should flow into India from Gift City. And so where if you set up an investment fund or an alternate investment fund, you will get not only some of the benefits which you get from Mauritius, Singapore, and similar tax havens, but you will also get exemption from angel tax provisions. Yes, this how long this will take, whether this will really bring in as much investment as the government contemplates through the Gift City, or whether investors would still prefer to to continue to invest from Mauritius, Singapore. This is something that time will tell. But these questions are pertinent questions which experts have been raising, that you cannot ignore these jurisdictions which are contributing so significantly to foreign investment to India. Policymakers so far have left these out from the exclusion list. Now, let's just look at two important concepts in the new regulations. So one is the price matching method, and the other is safe harbor, as I had mentioned. In price matching method, the concept is that if you have received an investment, if an Indian company or an undertaking has received an investment from a notified entity, a notified entity is the entity which has been excluded from the purview of angel taxation. And of course, notified entities operating out of a specified territory. So if you have received an investment at a particular price within 90 days from such a notified entity, then you can take the same price as the fair market value for the second round of investment. However, it is subject to certain riders. So one is, of course, that your second round of investment should happen within the 90-day period. And the second is also that the amount of investment coming in the second round should not exceed the aggregate consideration that you have received from the notified entity. So the term used in the draft notification is aggregate consideration. Now here, there could be some question mark on what is the meaning of aggregate consideration. So for example, if one of the tranches of investment by the notified entity falls within the 90-day period, but the other tranches fall beyond the 90-day period, then that significantly increases the size of the aggregate consideration. I believe that is what the intention of the government would be, to enlarge the scope of this price matching method rather than to restrict it. And if that is the intention, this could become a very useful provision, because then the investee would not be required to have a valuation report. Its price would also be accepted as the fair market value price for a significant amount of investment in the second round. So this price matching method is a new method which we see being introduced in the draft valuation rules for the first time. So I already explained what the price matching method is, but we can just take an example that if 1,000 equity shares are issued at a 50 rupees per share these are shares issued to an unlisted company by a notified entity, and the aggregate amount of investment received is 50,000. Then the subsequent investment in the second round, which will be within 90 days of the first investment round, that should be limited to 50,000 rupees only. It should not exceed that. Along with the price matching concept, we also have the safe harbor concept now. Safe harbor concept is not a new concept. We've seen it being applied in the transfer pricing regulations. So like there in transfer pricing, we have a plus minus 3% currently. For the safe harbor provisions for valuation, we have a plus minus 10% concept available. It's a plus 10% here really for the tax regulations, because your issue price cannot exceed the fair market value by more than 10%. And this safe harbor concept is available only in case of DCF, NAV, and the additional methods. It is not available for the price matching method. And again, it's available for both in case of resident and non-resident investors. This safe harbor concept is certainly a welcome move because ultimately valuation is a matter of perception, and you do need some band, some breathing room around it, and the government cannot insist that your investment should be spot on at the fair market value as computed by a particular method. So price matching concept and safe harbor concepts, these are both welcome moves by the government. Now when we look at these new provisions, so the main question is that how these new provisions are going to impact investment in India at large. And when we look at investment at large, especially in the private equity realm, unlisted shares, then the key instrument that is used very commonly is CCPS, compulsory convertible preference shares. So the issue is that now, as the angel tax provisions have been expanded to cover non-residents also, what is the fate of CCPS instrument vis-a-vis Section 56(2)(7)(b), and what are the chances of success for the investee companies? So we have just put up some thoughts on this this route before you. So Section 56(2)(7)(b) as such talks about issue of shares. Even after the amendment, it does not refer to preference shares per se. Under FEMA, yes, preference shares are considered as equity, and compulsorily convertible debentures are regarded more as debt. But when we are dealing with a taxing statute, we have to remember something, that a taxing statute is to be interpreted strictly, and especially if it's a deeming provision. It certainly should not be stretched. If it's a deeming provision, it has to be limited precisely to what the legislature has stated. So there are two important words which are used in the provision: issue of shares, where issue is important, and the word shares is also important, because issue does not mean conversion, and shares does not, simplicity does not imply preference shares. So just taking the provision at the face of it, one can argue that issue of shares does not include preference shares. And also when preference shares are converted, so then when equity is granted or issued, that is by way of conversion, and the legislature did not or does not contemplate here a conversion of shares. It's just talking about fresh issue of shares. These are the kind of arguments that we have taken in some of our cases, wherein even investments via CCPS have been challenged. I am presenting before you one Mumbai tribunal ruling also, wherein the court has clearly stated that preference shares stand on a different footing vis-a-vis equity shares, and so 56(2)(7)(b) will not apply. If the tax department accepts this principle, this will certainly give a lot of relief to startups, and as majority of the investment is through the CCPS route. And again, now next question that we can examine is, what is the fate of the compulsory convertible debentures, and are they covered under Section 56(2)(7)(b)? So like I said, that at least our view is that CCPS preference shares should not be covered under Section 56(2)(7)(b), and compulsory convertible debentures stand on an even stronger footing, because clearly, as the name suggests, these are debt, in the nature of debt, and not even in the nature of equity. So if the non-resident investor invests by way of CCDs, then certainly 56(2)(7)(b) provision should not apply. So from a planning perspective, when a non-resident investor is investing in an Indian company, what they can consider is that they should consider CCPS or CCD. With CCPS, there may still be some risk because it falls in the equity category. But with CCDs, certainly, you really have to stretch the fabric of Section 56(2)(7)(b) and stretch rather unreasonably to say that issue of shares also takes within its fold issue of compulsory convertible debentures. So on debt, we have a lot of rulings that debt is different from equity and is not shares. This is something which is now a settled proposition. So we can just, the audience can just have a look at these rulings. The slides will be circulated, so you will have that. So now, having just looked at the provisions, let's just briefly discuss, what are going to be the key concerns now for investors and startups. I will just come back to there are some questions in the chat, so we will just come back to the questions and the FAQs. We'll take them in the end. Let's just go with the flow and just move slide by slide. So with the expansion of angel tax provision to non-residents also, we can just have a look at some of the key concerns for both the investor and also the startup. So from an investor point of view, investors, it's critical that they must have a good exit option. So when we think of countries like Singapore, Mauritius, Netherlands, or even UAE, when they sell their shares because of the favorable treaty network, they will be taxed in the overseas jurisdiction, and they will be taxed at low rates because these are tax-friendly jurisdictions. So at the same time, the specified nations that have been excluded, these are countries which are not as tax-friendly as Netherlands, Singapore, so on and so forth. So the question is whether investors, just because there is an angel tax applicability on Mauritius, Singapore, or the Netherlands or UAE, would they really contemplate shifting out of these routes, or would they still prefer to remain in these routes? Because at the end of the day, their favorable exit option still is retained when they invest through these jurisdictions, and to have a favorable or a tax efficient exit option is an important concern for them. Yes, if they were to be given the choice of gift city, where you get a favorable taxation on exit also, and you get all the other benefits which you are getting in Singapore, Mauritius, then certainly they can consider that. Another key concern for the investor is that they must get a price which matches their perception of business valuation. Now, what is happening is, after the amendment to angel tax provision, is that there are already existing FEMA provisions which require that when investment comes into India, it must come at the fair market value. It should not be at a price which is below the fair market value. We also have now these added angel tax provisions. So section 5627B says, on the other hand, that when you are investing in India and you are not a part of the excluded entity or through a specified territory, then the investment price should not be above the fair market value. If it is above the fair market value, then it will be taxed as deemed income. So the bandwidth for the investor, or the buffer for the investor, has reduced. Investor and investee have to agree upon one price which is to be the fair market value. Of course, subject to the limited bandwidth given by the safe harbor, which is 10%. So fair market value or 10%, within 10% above the fair market value. That is the range for the investor investee to agree upon and to conclude their valuation report at. Startup, on the other hand, for startups, there are some serious concerns. Most importantly, because of the angel tax provision, there's a downward pressure on valuation. A startup cannot demand, or would not want to demand, a price higher than the fair market valuation from the investor, because a startup would then have to pay tax on the excessive amount from its own pocket. And that is something certainly a startup would never want. So until now, they could get investment even at a price above the fair market valuation. But now they cannot. From a foreign exchange perspective, this does not help Indian government, because FEMA's intention was that you should not get a price lower than the fair market value, so that foreign exchange does not suffer. Angel tax provisions are working exactly in a contrary direction. They are stating that your price should not be higher than the fair market value. So you are confined to the fair market value, or just 10% above. So your foreign exchange collection suffers. Startup is also under a constant fear of tax scrutiny, especially given the past few years precedent that we have, wherein bona fide investments have also been targeted. So the moment you do not have an exemption from angel tax provision, there is very much a possibility of a tax scrutiny, and a startup has to expend time and resources defending the tax litigation. So even if the startup ends up winning against the tax department at higher levels, it will have to go through that experience of I would say, a rather harrowing experience of tax litigation with the department, with unreasonable tax demand forced upon the startup, which is already struggling for funds, and which is why it has raised money. And even worse is if you are making losses, these are the easy pickings for the tax department, because tax department is very easily able to disprove the original projection vis-a-vis reality. Obviously, at the time of fundraising, no startup knows how the business will turn out, and projections are always optimistic. And later on, what happens, nobody can say. So if the startup, instead of making profits as projected, ends up making losses, then tax department has a strong reason to say that your actual performance is not matching with the projections, and therefore we disregard the valuation report which was drawn up earlier. This is something which has been a very standard practice, unfortunately, by the Indian tax department, and it ends up becoming a double whammy for the startup. So they are, as it is, into losses, and then a tax demand also comes upon them based on the funds which they had raised, and that entire funding is treated, sometimes the entire funding is treated as deemed income, and they are called upon to pay tax on that. So these are some problem areas from the extension of these angel tax provisions to non-residents. As I mentioned in the beginning, the logic of angel tax provision was to curtail black money, but that logic is not being applied before these provisions are being enforced. Domestically, they do issue notices to investors. They get into an examination of the source of funds. Even if they are satisfied, they still go ahead with the angel tax provision. Now that non-residents have come into the net also, I wonder what they are going to do as regards satisfaction of the source of funds. So imagine if these huge funds like Sequoia, Axel, which we all know have access to trillions of dollars, if they are called upon to prove their credit worthiness, how ridiculous it's going to be. And whether at all we need a provision like this. Are we saying that the money coming in from these funds, international funds, into Indian startups, when we are taxing them, when we are taxing their investment, we are under the impression that this is black money? I mean, what is the whole rationale? What is the purpose of this provision? So this is something. This is a policy question. I hope the government seriously rethinks about this provision. They have introduced this in the Finance Act 2023. It came as a shock, honestly, because we thought that there will be a tone down on the domestic angel tax provision itself. But instead of that, we realized that it has been extended. And now the rules also that have come out, they give some breathers. The rules give some relaxation. But fundamentally, if the provision itself is questionable, no matter how many relaxations you give around it, that provision will keep creating problem. Okay, so I think I will just have to, I'll have to just share the slide again. My system is just hanging. This. Right. Is that visible now? Yeah. It's visible, right? We'll just come back. So now we just come to some of the thoughts around angel tax provisions and what we foresee is going to happen in time to come. How the fund houses and investors or investees will try to plan around it. So of course, one way to get around angel taxation is to take a DPIIT registration, but there are limits to DPIIT registration because only startups meeting certain thresholds Their revenue should not be more than 100 crores. The aggregate amount of equity investment should not be more than 25 crores, so on and so forth. Plus, they should also show a technology orientation. So subject to all these limitations, if you get a DPIIT registration as a startup, then 56 to 7B will not apply. Now, outside of that, what are the choices which are available? Because a 56 to 7B now applies to non-resident investors also, there can be a move towards taking investment outside India rather than in India. So set up a company in Singapore, Mauritius, or any of these entities and raise money there instead of raising in India. Another option is that if you want to still raise it in India, then you do it through a notified entity from a specified territory, or you do it partly through a notified entity and partly otherwise, but within the 90-day period, taking benefit of the price matching method, which we just discussed, so that the price that you get from a notified entity, that you can rely upon as the fair market value. So these structures are going to evolve in time as the rules get finalized and the investees also become savvy. Instrument option is also available, that instead of going for your standard shares, you go for CCPS and CCDs, and there could be a more inclination towards debt now instead of shares. So you will see more preference for CCDs or CCPS. Yes, it's there, but at the lower levels, we cannot rule out challenge by the tax department. They may try to take CCPS also within the fold of section 56 to 7B. Technically, I believe that it should not be covered, but that's a fine point, and you may only get favorable result at higher levels. And if you don't really plan around it and you just want to ignore angel tax provisions risk per se, risk of a challenge by tax department, and you want to go ahead with the investment, then advice is that you take your valuations very seriously in terms of preparing the backups for the same. You have a contemporaneous valuation report drawn up. You take reasonable growth rates, realistic assumptions, have all justifiable backup workings. And if you have all of that, then you certainly, even if a litigation does come up with the tax department, you have a very strong case and you can defend it. Almost in all the tax litigations around angel tax, it is the taxpayer which is coming out as the winner in majority of these cases. And you have a very favorable rulings also coming from the courts, wherein the courts have unequivocally said that you cannot challenge a valuation drawn up by an expert. Projections are not something which can be judged based on hindsight. So a company may have incurred losses later on, but just because now you know that it has made losses, you can't question the projections which the company had drawn up at an early point of time. They had no knowing, for example, that COVID would come up. So a restaurant or a hospitality company which is taking funds before COVID obviously didn't know that COVID will happen, and its projections are optimistic. But then, for example, if COVID happens and things go haywire, you can't question the valuation based on the facts which have happened later on. So these are some very common sense principles which have evolved, and the courts have understood all of this. They have also said that 56 to 7B is a deeming provision that needs to be applied strictly. Its scope has to be limited. Bona fide commercial transactions are not to be taken within its fold. So like we mentioned that unaccounted money, black money, that is the target of section 56 to 7B provisions. So if you have creditworthy investors, then what is the need to apply 56 to 7B? If we know that funds are coming from funds, and that too from tax-paid money is coming into the startup company through banking channels, then why should you at all apply 56 to 7B? So we have all these decisions in favor of the taxpayer. And if the way you get around angel tax provision is that either you structure your transaction in a manner that you are safe from angel tax provisions completely, or if you cannot do that, then you at least do the compliance part properly, have a strong, robust valuation report, and you take care of all these points which we have just mentioned, and then you should be fine. Though yes, litigation with department cannot be ruled out. So the crux of the concept, all the points I think now covered, and I think we have time. We can leave the floor open for the Q&A session. So one question from Mr. Sandeep Kothari is that under FEMA, money can come above the fair value. So yes, it's true that money can come under FEMA above the fair market value. There was no problem until now, because now we have angel tax provision. So section 56(2)(7)(b) says that if your investment is happening at a price above the fair market value, then the excessive amount will be deemed to be income of the startup company or the investee company, and you will have to pay tax on the differential amount. So the problem is not under FEMA perspective, but the problem is under the tax regulations perspective. You can only go up to 10% above the fair market value under the tax regulations, because that is the maximum safe harbor. So CCPS, we mentioned about, so next question by Mr. Sandeep is that what is the source to say that CCPS would fall within 56? So on the contrary, we are not saying that CCPS would be covered. We are saying, we are of the view that compulsorily convertible preference shares should not be covered under 56(2)(7)(b), because 56(2)(7)(b) in our view applies strictly to shares. And there is also a supporting favorable ruling by Mumbai Tribunal, which we had referred to, and I'll just share that again, Golden Line Studio. So this ruling actually says that that preference shares should not be within the fold of 56(2)(7)(b). But from experience, what has happened at the lower levels in dealings with the tax department is that in some of the cases we have seen that tax department has aggressively applied 56(2)(7)(b) not only to CCPS but also to CCDs. Obviously, now this is not a technically right approach, and these additions will get quashed at the higher levels. Some of them already have been quashed, and some of them most likely will get quashed at the higher levels. But all that notwithstanding, the unfortunate fact is that a startup which is trying to get on track, trying to become profitable, that is unnecessarily heaped upon with this very much avoidable litigation. Yes, correct. So this ruling is for convertible, non-convertible preference shares, but we are trying to highlight a principle here that preference shares per se are a distinct class compared to simple equity. So the principle that we are highlighting is that number one, section 56(2)(7)(b) is a deeming provision. It needs to be interpreted strictly. And secondly, whether it is convertible or non-convertible preference shares, it's a different class of instrument. So it should not, a 56(2)(7)(b) should not apply. Another question from Mr. Sanjay Gupta is that regarding who are allowed to do the valuation. So we will just move back to the method slide. So for DCF, only a merchant banker can give a valuation. And again, for the additional methods available for non-residents, again, only a merchant banker can do the valuation. For NAV, there is no prescribed expert as such, because NAV is a simple method and anyone can just do an NAV valuation. But for other methods, you need a valuation expert. Mr. Kothari, I hope your questions have been answered. And so I'm just looking at some of the. So there is one question that what kind of contributions from non-residents is subjected to angel tax. So we just discussed that any investment via shares equity in an Indian company or a startup, that will be subject to angel tax unless you are falling in a excluded category. So either you are a excluded entity operating out of a specified nation, and there's a list of 21 nations that have been specified. There's also a list of the excluded entities which are specified. So if you are covered in any of the exclusions, then angel tax will not apply. Yes, another question is it prospective or retrospective? The answer is yes, it is prospective. So another, I think we'll just take up. Someone has asked to explain the 90-day point again. I will just go back to the 90-day point, which is the price matching concept. So basically, price matching concept is simply says that if you are getting investment, if a startup is getting investment from one of the notified entities, which is not subject to angel tax provision, so that can be taken as a benchmark. The price at which investment is coming from a notified entity in a specified territory can be taken as a benchmark, and you can take that price as the fair market value for your next round of investment. But there are certain riders to this. One rider is that your next round of investment should be within 90 days of the time when you got the investment from the notified entity. And second rider is that your investment in the second round should not be higher than the aggregate consideration that you have received in the first round. So if you got, let's say, rupees 50,000 worth of investment from the notified entity, then your exemption from angel tax provision in the second round is also only up to 50,000. And if you are seeking an investment beyond 50,000, then you need to get a fresh valuation report. You cannot rely upon the price which you got in the previous round as the fair market value. You must get a fresh valuation report for that. I hope that clarifies. Right. So I think we are done with most of the questions now. So this certainly, now with these new valuation rules, I think there will be a lot more cases of angel taxation. It will be interesting to see how this plays out. There will be more huge tax demands coming up from startups, especially on funding from foreign investors. There will be more tax litigation around this. This is not these rules, also the draft rules that have come up to provide some leeway, breathing room to the startups. These will have their own issues. There will be more complications and a lot more litigation. Right. So any other questions? So there is one question, which is if there are any specific guidelines for how to determine value for notified entity in specific territory. So a notified entity, from a specified territory still has to make a valuation report, because they still have to comply with FEMA regulations. They are only exempt from angel tax provision. So they will have to follow the standard route of having a DCF based valuation report, or depending upon whatever method better suits their facts and circumstances. So which will be as per the FEMA guidelines. So unlisted, one question is whether unlisted entities are also covered. No, unlisted entities are not within the purview of angel tax, section 56(2)(7)(b). So for all, for all valuers, all startups, even investors investing in India, now these valuation rules and these changes that have come out, it's very important to know. You also need to understand that now every time you do a new round of funding and your previous round was older than 90 days, then the question is whether you need a fresh valuation report or not. The answer is that yes, you would need a fresh valuation report if your older valuation report is older than 90 days, because the validity time period as per the rules is only 90 days. You could probably have the same valuation report again certified by the merchant banker if no underlying facts have changed. But as per the rules, the option with the assessee to use the same valuation report is available up to 90 days only. So one interesting question from Grace is that whether recognized startups will be given a blanket exemption when 56 to 7B actually intended to capture paper companies. So this is what we really do want. We want that section 56 to 7B should not at all apply to bona fide investments and to companies with real operations. It should only target black money. And if the government has given some exclusions in the form of a DPIIT registered startups, but this exclusion still has not served the purpose. It has not helped to reduce the litigation around angel tax. Whether the government will altogether exclude bona fide startups, this is a point which can be lobbied and mooted before the government strongly. But yes, the investor community and the startup community has been clamoring for this. Courts have given very favorable rulings on this point, that bona fide investments should not be targeted. In my view, this provision 56 to 7B should be entirely done away with. It is not a provision which in the long term will serve the national interest, because it is only creating needless confusion. An alternative approach to this tackling of black money could be to have strong checks built in section 56 to 7B on the source of funds. So if you give power to the officer to inquire on the source of funds, make the investors satisfied that their money is coming from legitimate sources through banking channels, if creditworthiness is established, then a safe harbor based on these checks should be built in, that then the investee company should not be targeted. If you have satisfied that all the money has come, which is tax paid money, it has come through legitimate sources and banking channels, then why are you applying 56 to 7B? If this provision, if this kind of test is built in 56 to 7B itself, then I think the problem will be solved to a large extent. Also, then 56 to 7B would really be aligned with its original objective, which is to curtail black money. But right now, what is happening is that they are applying this in a rampant manner, and even in those cases where tax paid money, already money on which tax has been paid, that is being contributed by way of investment, they are again deeming that to be income. So that is a very unfortunate thing, and it is adversely impacting the investment climate in the country and contributing to what we call as the funding winter, where fund sources are drying down. So this is another another negative aspect. Grace, I hope I answered your question. It's really a policy question, and I can't crystal ball gaze as to what will happen, but I really wish the question that you're raising, that happens really. That would be the best for all of us. Right. So any other questions? I think so one question from Venkat is whether angel tax is applicable even for the first investment. So yes, it's true that it is applicable on every issue of shares. There's no distinction as to first round or second round. You have to take care that when in a case where you do not have any revenue projection and it's a startup just needing funds, so unfortunately, it applies even in that scenario. Like we mentioned, the way you can avoid angel tax is that you take a DPIIT registration. If you're a startup and your revenue does not exceed 100 crores, your investment is not exceeding 25 crores, and subject to some other conditions, you can apply for a DPIIT startup registration. Once you get that, then 5627B provision will not apply to you. Right. So friends, any other questions? Venkat, I hope I answered your question. So I think we are just on time now.